Greetings, everybody. Welcome to Liberty Call. Today is, actually, hang on. Let me check my settings, make sure all right, it's working. Good. Welcome to Liberty Call. Today is Monday, August 21st, 2023. Hope everybody's having a good day and weekend out there in the interwebs. Let's see. Not the most fantastic day in the markets. The NASDAQ and the S&P were in the green, but the Dow Jones was in the red most of the day. It did come back much closer to the midpoint, but not the like I said, not the most outstanding day in the markets. Again, I am glad you're here. Thank you very much. If it's your first time watching the Liberty Call, if you could give me some thumbs up, like, share, subscribes, follows, hit the notification bell so you know when I go live. And let's go ahead and jump into the numbers for today. All right, Dow Jones down 0.11%, 36 points, closed at 34,463. The S&P 500 was up 0.68%, and closed at 43.99. NASDAQ up 1.56%, closed at 13,497. The VIX was down 1.04 today. It's currently holding at 1712. It was in the green earlier today. Canada was down 0.17. Brazil was down 0.83, and Mexico down 0.15. Over in Europe, Germany was up 0.19. The UK down 0.06. France up 0.47, Netherlands down 0.2, Spain down 0.05, Italy up 0.81, Switzerland up 0.09, and Portugal up 0.27. Russian exchange is both in the green again today. MOEX up 0.92, RTSI up 0.95. And the overnights, the Nikkei in Japan was up 0.29%, Australia down 0.46%, New Zealand down 1.03%. In China, the Shanghai was down 1.24%, the Shenzhen component down 1.32%, China A50 down 1.36%, DJ Shanghai down 1.3%, Hang Seng down 1.65%, and it looks like the Taiwan weighted is flat at 0. Looks like it was up 0.18 points. All right. So that is the weekly indexes for the day. Sorry. Thanks for helping me out there in the interwebs. All righty. Well, let's go ahead and get on over to the weekly update and jump through that real quick. Stocks extended their August declines last week as higher yields and weak economic data out of China soured investor sentiment. The Dow Jones Industrial Average lost 2.21%. The S&P 500 retreated 2.11%. NASDAQ backtracked 2.59%. And international slumped. Stocks wilt. Rising bond yields, driven primarily by strong economic data and the release of the minutes from July's Federal Open Market Committee meeting that pointed towards Fed officials' potential need to raise rates further, weighed on stocks throughout the week. In a week of light trading, typical of August, stocks were additionally buffeted by a string of economic data that painted a flailing economic recovery in China and warnings of potential downgrades of dozens of U.S. banks by Fitch, a credit rating agency. After the 10-year Treasury yield rose to its highest level since October of 22 on Thursday, yields eased on Friday, helping to arrest the week's downward trend. Retail sales surprise. Retail sales jumped 0.7% in July, the fourth consecutive month of increasing consumer spending on goods. The report supported the growing narrative that the U.S. may be able to avoid recession in the near term. What do you think out there, folks? I don't think so. Where were we? The strong spending data supported by a robust labor market also may have placed the Fed in a more difficult position in trying to bring inflation down to its target rate without more rate hikes. Consumer spending was higher in most categories, including bars and restaurants, grocery and hardware stores, and back-to-school items like books and clothing. Sales of autos and electronics fell, a possible consequence of higher borrowing costs. Data coming out this week. Tuesday, we have existing home sales. Wednesday, we have the Purchasing Managers Index Composite Flash and new home sales. Thursday, we have the durable goods orders and jobless claims. Companies reporting earnings this week. Today on Monday, we have Zoom Video. Tuesday, we have Lowe's Company. I do my part to keep them in business. Wednesday is Nvidia, Autodesk, Analog Devices, and Snowflake Inc. That's probably owned by a Democrat. Thursday, Marvel Technology, Ulta Beauty, Workday Inc., and Dollar Tree. All right. Well, that was everything for the weekly update. I know you're excited out there, right, folks? My buddy Jake back here, you can see him. He's resting because we're going to go play in a little bit. So you can see his little blue wiener right there. It's the face of it. So anyways, all right. Well, let's go ahead and jump into the market recap. S&P 500 rides Nvidia surge, shrugging off jolt and Treasury yields to 16-year high. All righty. Notes. All right. The S&P 500 displayed a positive trend on Monday, primarily attributed to the surge in tech stocks led by Nvidia Corporation. Nvidia's stock witnessed a remarkable rise of over 6% ahead of the release of its quarterly results scheduled for Wednesday. This surge is attributed to the company's strong performance in the previous fiscal quarter, where it outperformed Wall Street expectations and provided optimistic guidance. Investor anticipation of Nvidia's third quarter results is heightened due to the positive outlook regarding growth in data centers driven by AI. Market experts have pointed out that demand for Nvidia's AI GPUs is expanding beyond cloud service providers, including emerging AI clouds, sovereign states, and large enterprises. In the realm of Treasury yields, the 10-year Treasury yield reached levels not seen in over 16 years, suggesting that investors are bracing for potential hints on monetary policy from Federal Reserve Chairman Jerome Powell. Investors expect Powell to emphasize the need for sufficient restrictive policy stance to manage potential inflation risks despite healthy economic growth. And I think he's due to talk at the it's not Steamboat, it's Jackson Hole, the Jackson Hole Symposium this week. Tesla Inc. also witnessed a surge of more than 6% as investors seized the opportunity to invest in electronic vehicle manufacturer after a recent dip. Positive remarks from Wall Street included being placed on Baird's best ideas list, contributed to the rise. The positive factors highlighted include the impending Cybertruck launch, growing adoption of self-driving software, and the continued expansion in the energy sector. Another noteworthy performer was Palo Alto Networks, a software company that saw its stock rise over 15% after reporting quarterly earnings that exceeded Wall Street expectations. The company's annual guidance also surpassed estimates. Market experts emphasize that Palo Alto Networks' comprehensive cybersecurity platform, combined with its strategic growth initiatives, positions the company for sustainable, profitable growth. In summary, the S&P 500's upward movement was driven by several key factors, including Nvidia's anticipated strong quarterly results in the tech sector, increased Treasury yields reflecting investor expectations of a Fed policy, Tesla's rebound based on positive analyst comments, and Palo Alto's network's better than expected earnings performance. These developments underscore the dynamic nature of the financial markets and the impact of various factors on stock movements. Exciting stuff, I know. All right, one last article comes from our friends over at First Trust, Mr. Brian Westbury, their chief economist. This week's article is titled, "Where is the Economy?" All right, let's see what he had to say. The current state of the markets and the economy has shown several intriguing dynamics. Long-term Treasury yields have significantly risen since the previous fall, contrasting with the stock market's recent stumble after a substantial rally. Meanwhile, the real economy seems to be maintaining its momentum and even accelerating, while inflation, although having dropped considerably compared to last year, is anticipated to rise again due to increasing oil prices. I said that a few weeks ago. Remember? Were you paying attention? These developments prompt a reevaluation of the fundamental outlook. As of April of this year, the 10-year Treasury yield stood at 3.3%, but is now surged to 4.3%, indicating a 1% point increase. This can be attributed to various factors, including the real economy's unexpected prolonged strength. In the second quarter, the economy saw a moderate growth rate of 2.4%, and the Atlanta Fed's GDP now model predicts an astonishing 5.8% annual growth rate for the third quarter. I'll believe when I see it. After the final revision, not the first numbers that come out. Those are usually BS. While projections suggest a real GDP growth rate of around 4% for Q3, even this would be considered remarkably robust. Notably, such a growth rate hasn't been achieved since 2017, apart from the COVID-related reopening in 20 and 21. In terms of inflation, a significant drop has occurred from a year ago, with consumer price Index showing an increase of 8.5% in the year ending July 22 and a comparatively lower 3.2% for the year ending July 23. However, due to recent surges in oil prices, the year-over-year comparison is expected to increase to around 3.6% in August. Consequently, projections suggest that GDP prices will rise at a 3.6% annual rate in Q3. With both real GDP and GDP prices expected to rise in Q3, it's unlikely that the Federal Reserve will maintain its current 5.375 level for short-term rates. The future market indicates only an 11% chance of a 25 basis point rate hike at the Fed by the Fed in September, along with a 40% chance of a cumulative 25 bips increase through November. These probabilities could rise, potentially leading to further increases in long-term rates in the coming month. Considering the scenario of increased growth and persistent inflation, it's plausible that the Federal Reserve might act beyond market expectations and maintain a higher level for an extended period. Whew, easy for me to say. This outlook supports the previously made forecast for that the S&P 500 would conclude the year at 3,900. Additionally, the expectation of a recession has been met with skepticism. The prevailing notion that a low unemployment rate of 3.5% shields the economy from a recession is challenged. Historical data suggests that recessions often commence when unemployment is at or near a low. Economic downturns are often a consequence of excessive optimism in the light of underlying economic conditions. Factors such as diminishing purchasing power following the conclusion of COVID spending programs, escalating labor costs for businesses, and potential corrections in business investments contribute to a less sanguine outlook. Moreover, recent government policies may not sufficiently enhance long-term growth prospects. While artificial intelligence holds promise, its immediate impact on growth might not be as substantial enough to ward off a downturn. Amid these observations, a tightening monetary policy designed to curb inflation to 2% presents a challenging economic journey ahead. While the road seems relatively smooth now, potential obstacles lie ahead in the form of economic potholes. Yep, and if you've ever driven down a dirt road in a truck, especially my truck, it is very bumpy and you shake all over the place, especially if you got a washboard on there. So there's a lot of bumps in front of us, folks, and just be careful. Check your suspension, check your tires, whatever you got to do to make sure that as we're driving into the future, you're not going to get a flat or stranded somewhere along the way. So if you need help with that, I know someone who can help you out. This guy. So go to dsafinancialgroup.com. I can help you get your retirement planning in order, all your other finances, and just make sure you don't have any holes in your financial life so that if something unexpected does happen, it doesn't derail your future. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.